Democrats and Republicans in Congress started warning in September that the debt ceiling would need to be raised above its $28 trillion limit, or the country would risk defaulting on its debt altogether. But this fight is really nothing new.
That's right. The decision to raise or change the definition of the debt ceiling has been made by Congress 78 times just in the last 60 years. And while Republicans have been the ones resisting it this year, the overwhelming majority of those changes have actually been made while a Republican was in the White House. In fact, the national debt hasn't hit zero since the Andrew Jackson administration in the 1830s. But major events such as World War II, 9/11, and the Great Recession have added to it significantly over the years.
And many may remember when the national debt hit $1 trillion for the first time back in 1981. The Ronald Reagan administration combined an increase in defense spending with tax cuts. The deficit decreased slightly under the Clinton administration, and it stood around $5 trillion when George W. Bush took office. But his administration more than doubled that number, bringing it to over $10 trillion. President Barack Obama then doubled it again, raising the national debt to nearly $20 trillion.
Now, in order to fully understand how the national debt impacts the country, we have to look at where it stands compared to our gross domestic product. Now, last year's spending in response to the pandemic brought the debt to GDP ratio to 105%, marking its highest point since World War II. But if we go back to the 1990s, we'll find that the ratio stood under 50%, even dropping down to 30% under the Clinton administration. The debt to GDP ratio was up to nearly 45% by the time George W. Bush left office, and by the time Obama left office, it had skyrocketed to nearly 75% as the continued increase in defense spending combined with the government's response to the Great Recession.
So who owns all of this debt? The two largest entities are actually right here in the United States: the Social Security Trust Fund and the Federal Reserve. That's public. That's the debt of the people. Now, beyond that, China and Japan both own more than $1 trillion in U.S. Treasury securities, followed by the U.K., Ireland, Luxembourg, and Brazil.
So what is the significance of all of this debt, and what would it mean if the U.S. were to actually default? Well, joining us now to discuss are Professor Richard Wolff, host of the Economic Update, Peter Schiff, chief economist at Euro-Pacific Capital, and Steve Keen, the economics professor of Patreon. It's great to have you all on the show today. And Professor Wolff, I want to start with you. Now, when we look at the way the debt has grown, have we just come to expect that Congress will continue to spend more as time goes on at this point?
Yes, I mean, basically we have waltzed ourselves into a kind of corner from which it is too dangerous to try to escape. The debts are so enormous at this point. And by the way, not just the federal debt, but corporate debt and individual household debt, that even the effort to raise interest rates a little bit becomes a risk and a shock that an already troubled economy can really not cope with. So that we are in a situation where we have to keep funding a debt, even though it becomes more dangerous as we do so.
And Peter, when we look at a lot of the reasons the national debt has jumped over the years, it seems there's always something, whether it's the Great Recession, World War II, a global pandemic, or even the war on terror. In some capacity, do you ever see this spending being justified based on current events?
Well, first of all, you know, the debt continues in good times as well as bad. We never have any surpluses when times are good to pay off the deficits we incur when times are bad. But I want to correct a couple of mistakes that you made earlier on with the debt. First of all, the debt to GDP, it's actually 125%, not 105%, because the 105% doesn't count the debt held by the Social Security Trust Fund. So when you count all the debt that's outstanding, it's 125. But that doesn't even tell the whole picture, because you have to look at the state government debt and all the municipalities, because everybody is looking at the same tax base to repay the debt. So when you measure all government debt in the United States, you're looking at 140%, 145% of GDP. But that's just the tip of the iceberg, because it doesn't count any of the unfunded liabilities of the United States government. Those are commitments to pay things like Social Security or Medicare benefits or guaranteed student loans. And when you add all that together, you're talking about several hundred times the GDP of how much we've run up in debt. And the problem contrary to what everybody is talking about, the problem isn't the debt ceiling. The problem is the debt. The problem is we keep raising the ceiling, so we keep on piling on more debt.
Now, Steve, I want to give you a chance to respond to that. I know we've talked about how the national debt has grown and how those figures just continue to grow, of course, when you do take the time to factor everything in. Is this something that you see as just inevitably continuing to grow, especially the way that Congress is operating right now?
If you want to continue having a capitalist economy, yes, it has to grow. And this is the reason why I find some of this alarm quite laughable, frankly, because I'll take one of Peter's figures about the level of government debt being 145% of GDP before some of the other things he added in. That's actually less than the level of private debt, which is running at about 165% of GDP right now. And that's the real problem. Personal debt is a problem. Personal debt does constrain what individuals can do, and falls in personal debt do cause crises. That's what we should be worrying about. But all the stuff about government debt, and I'm talking specifically the federal debt here because federal debt is different to state debt. It doesn't have anything like the same problem. In fact, it's part of the reason why capitalism works, because when the government runs a deficit, it creates an identical surplus for the private sector. The government deficit is the private sector's surplus. If the government runs a surplus, the private sector runs a deficit. And I know this is hard for people to get their heads around, but it's actually the accounting involved, and it's easily shown using accounting software that if the government spends more than it gets back in taxes, it puts more money into private bank accounts than it takes out through taxes. And the only question is, does this end up meaning the Treasury has a negative account at the Federal Reserve or a positive account at the Federal Reserve? That's what bond sales are for, and that's what the coin could be for as well.
And Peter, I want to come back to you on this because, I mean, obviously this is a broad conversation about the state of debt that we will continue here throughout the half hour. But the question is, what are really the negative, the downsides of holding all of this debt? Because it does seem like there's a lot of give and take in this.
Well, the debt is a huge problem. It doesn't help capitalism. It interferes with capitalism because what happens is the government is taking resources away from the private sector and diverting them to public spending. And this undermines capitalism. It undermines savings and investment and all the things that we need to grow our standard of living. The problem is much of this debt now is being monetized by the central bank. The Federal Reserve prints money to buy up all this debt. And all that is levying a massive inflation tax on the economy. And this is only getting started. Prices are going to explode in the United States for all manner of consumer goods, especially goods relative to services, because the American economy, after years and years of deficits crowding out private investment, we are completely dependent on the productive capacity of the rest of the world. We are running record trade deficits. Just yesterday, we printed the largest monthly trade deficit in U.S. history, better than $73 billion. Those deficits are going to keep getting higher and higher. And eventually, and I think relatively soon, the value of our money, the dollar, is going to collapse. And all the prices of the imported goods are going to be going up much faster than they are right now.
And Professor Wolff, I know we have pretty much this same conversation with you quite regularly about trade and what Peter's talking about. What do you make of Peter's comments there?
Well, I'm always mystified by Peter's comments because if this is against capitalism, he does have a problem of explaining it. Is everybody wrong except him? Is everybody making a terrible mistake? Is the system self-destructing?
Most people, yes.
I don't think so. I think this is a system that's got basic problems and is trying to solve them by printing a great deal of money and exploding its debt. It's really solving one set of problems by this debt creation, by this monetization, and then it creates a new set. And it has bumbled through for 2 or 3 centuries doing this over and over again. And everybody kind of knows that eventually you're going to solve one problem by creating another one, and then you won't be able to solve it, and then this system will come down. That's the problem.
Well, American capitalism did great until the U.S. government corrupted it. You know, we had a vibrant free market economy under a gold standard when we had honest money, when we didn't have a federal income tax or Social Security tax. We didn't have any of these types of spending programs that we have today. And we had a thriving middle class. We had an economy that really was the envy of the world. We built a standard of living that was unmatched anywhere else in the world. The problems really started when government started to grow and started to impose more regulations and more subsidies and more government spending, and the Federal Reserve came around. So these problems were not created by capitalism. They were created by government's interference with capitalism. And every time government tries to solve the problems that they create, they make those problems even worse.
Well, Steve, I want to give you a chance to weigh in on this. I know we've talked a lot about the different systems, but do you see the United States as having a free economy, especially when it's Congress that is deciding to continue to add on to the national debt, which they say that we own, but the American people don't really seem to have much of a choice in the matter?
Well, the American people have a choice. They can do what happened during the 1920s. And let's go back. I think that's before, I think Peter would admit that's before government debt got to be particularly large. At that stage, government spending was about 5% of GDP or less. And Calvin Coolidge decided to run a surplus for his entire term. And during the 1920s, he did precisely that. He ran a surplus of roughly 1% of GDP every year. And of course, the economy boomed, and he took credit for it and said that the surplus was the reason the economy boomed. When you look at the data carefully, what you find is, yes, there was a government surplus of 1% of GDP every year, and every year the private sector was borrowing roughly 5% of GDP to speculate on the stock market. Now, that's what gave it the turbocharged economy, not the surplus, but the government, but the deficit being run by the private sector. To borrow and gamble, let me finish, Peter, to borrow and gamble on the stock market. And over that period of time, the private debt level rose, more margin debt, okay, just debt to gamble on shares, rose from 1% of GDP to 13% of GDP, and then crashed right back down again. That's what gave us the Great Depression. Now, that sort of irresponsibility on the private debt side is the real Achilles heel of capitalism, and worrying about the government's behaviour is, frankly, identifying the wrong problem.
And Peter, I'm going to give you the final word. You have 30 seconds before we go to break here.
Yeah, the problem was the Federal Reserve was created in 1913, and it was their easy money policies in the latter part of the 1920s that inflated that stock market bubble. And when it popped, what created the Depression was the interventionist policies of Herbert Hoover and then Franklin Delano Roosevelt. That's why we had a depression, was because we had too much government and we had a central bank. If we didn't have either, then we wouldn't have had a depression at all.
All right, I know we've got a lot to talk.
And we wouldn't have had the stock market bubble. You can shake your head, but that's the fact.
Global debt is ballooning and could lead to a catastrophic outcome, with global debt rising to a new record high of nearly $300 trillion in the second quarter. What does this mean for economies around the world? Boom Bust co-host and investigative journalist Ben Swan is following the story.
Well, as you say, global debt now stands at a whopping and record $296 trillion. But what's really interesting is that almost 10% of it, or 19.5 trillion, came about just during the coronavirus pandemic. Well, prior to the pandemic, the world's debt to GDP ratio rose 356% in 2020, up 35 percentage points from where it stood in 2019. That's according to a new report from the Institute of International Finance. It also found that countries saw their economy shrink, and they issued an ocean of debt just to stay afloat. But now, in the battle against COVID, governments around the world are now more indebted than at any other point in modern history, even surpassing World War II. Not only are governments around the world spending vast sums of money to fight the pandemic, but big corporations, which have been emboldened by unprecedented government support for markets, are selling bonds like never before. All that debt now means severe cuts to public spending on health, education, and social protection programs globally. The International Monetary Fund believes that 35 to 40 countries are debt distressed, defined as when a country is experiencing difficulties in servicing its debt, such as when there is debt restructuring. Countries falling into debt distress include Tunisia, which has seen political upheaval, as well as Zambia and Ghana. Zambia was the first African country to default on debt last year during the pandemic. So how bad is it? Well, now Zambia has to allocate 44% of its annual government revenue to creditors. Ghana spends about 37% of its national budget on debt interest payments. Cameroon spent 23.8% of its budget on debt payments, compared to just 3.9% of the country's revenue on health. And all of this leads a number of analysts to say that we are now in a debt supercycle and that central banks are in a trap which could ultimately lead to a global economic collapse. For Boom Bust, I'm Ben Swan.
And for more on this, let's bring back our panel of Professor Richard Wolff, host of Economic Update, Peter Schiff, chief economist at Euro-Pacific Capital, and Steve Keen, the economics professor of Patreon. Steve, I actually want to start with what Ben just mentioned there. As you see a nation default or face major debt woes, and then they're owing 44% of their GDP to creditors, what is that doing to them?
Depends on whether they have their own currency or not and whether they're running a trade surplus or not. A country running a trade surplus, and let's take Japan as an example there, is quite capable of continuing to issue government debt indefinitely. On that particular case, Japan, I think, has the world record. 250% of GDP is its government debt level. Is the economy suffering? No. On a per capita basis, it's been growing faster than the United States for most of the last 15 years. And it can do it indefinitely because with a trade surplus as well, it's not selling its bonds to foreigners, and foreigners, if they do buy those bonds, are quite happy to be paid in Japanese yen. Now, the problems arise for countries which are running trade deficits, which can't borrow in their own currency. They're the ones who are up, the proverbial creek without a paddle. But when you have a country which is either running a trade surplus like Japan, or in America's case, which is unfortunately, and it should not be, is unfortunately the reserve currency for the planet, that you can get away with it indefinitely. So again, we're worrying about the wrong things.
Now, Professor Wolff, I mean, when it comes to debt between more developed nations, it really is a delicate balance with a lot of give and take. In some cases, is having ongoing national debt actually healthy?
No, in most cases, this is just a kind of continuation of old colonialism and imperialism under a slightly adjusted set of circumstances. Instead of literally carrying the gold out of the country somewhere in Africa back to Europe or over to the United States, or ripping off the local people to make them work for next to nothing, you are now doing it with loans. You're giving them a loan, you're greasing the wheels of the loan with large amounts of fees and commissions, and I won't even speak about the corruption that is going on both sides. So you end up with very little of that money going into any kind of long-term progressive economic growth, and so the burden of the debt is not matched by an ability to pay for it, so it becomes these crazy numbers that Ben just went over. And this is terribly bad for these poor countries already, deepens the inequalities in the world, and creates political and social instability that we will all be regretting every week and month into the future.
And Peter, I want to kind of make a counterpoint here that I think you will have a great answer to here, because could this global debt issue result, or should it for that matter, result in a destabilization of fiat currency so much that governments and citizens will be forced to actually rely on other means? You often talk about the gold standard. Obviously, on this show, we regularly talk about cryptocurrency as an alternative to fiat. What do you make of all of that?
Well, certainly, first of all, while it's true that governments can certainly get away with having too much debt for a while, and some, can do it for a long while, no government can do it indefinitely. There's always going to be a day of reckoning. But the important thing to look at, too, with the debt is, why do we have so much debt? I mean, it's not an accident. You have global central banks led by the Federal Reserve keeping interest rates artificially low. And it's because interest rates are artificially low that there's so much debt. And the problem, too, with the debt is that it's not productive. You have individuals borrowing money to buy consumer goods. You have corporations borrowing money to buy back their overpriced stock. You don't have productive debt where we're investing in plant and equipment that is actually generating real income to service and retire the debt. You have this gigantic speculative bubble. You have asset bubbles all over the place. None of this is a byproduct of capitalism. It's all because of the failure to have capitalism. If we had capitalism and sound money, we would have much higher interest rates. We wouldn't have all this debt. We'd have a much more prosperous economy. But to answer your question, yes, all of this is leading to a currency crisis that will begin in the United States as both a sovereign debt crisis and a U.S. dollar crisis. And it will unleash, rampant inflation throughout the world. And ultimately, a lot of this debt is going to be inflated away. I mean, the debt can't be paid. And so most governments don't have the integrity to honestly default and it's going to get wiped out through inflation. And then where we go in the aftermath of that is difficult to say. But the world is going to go through a very, very difficult period because a lot of these paper wealth is going to get wiped out. So a lot of people that think they have money invested in bonds, government bonds, corporate bonds, whatever they got, they're going to find out they have very little because the purchasing power is going to be eviscerated because the cost of living is going to surge. And they're locked into the paper and they don't have any way to pay the higher costs.
Now, Steve, what is your response to this? I mean, I know we've talked a lot about the bubbles that are coming up, but I mean, are we facing a global crisis on the scale that Peter is referencing here?
I can't help thinking of what I was told once is the way you get punished in an American jail if you're really misbehaving, and that is rather than giving you a plate with meat and vegetables and stuff on it, they put it in a blender and blend the whole lot together and serve it to you, and apparently it tastes yuck, even though individual units can be quite delicious individually. Peter's thrown a whole lot of stuff in the blender there, and some of it, yes, is a serious worry. Others, no, is not at all the problem. In fact, it's a necessary part of a functioning capitalist economy. We do have too much private debt. Far too much of the debt has been used to speculate on asset prices and not produce productive investment. That's quite true. But as for defaults being caused by government debt, the only time that happened with governments borrow in a currency which is not their own. That's what's caused government defaults. When you look at the last 150 years, there have been roughly 150 financial crises in different countries around the world, and every last one of them has been caused by private debt collapse. So it's private debt which is the problem, government debt which is often the solution.
Yeah.
Hyperinflation is going to probably, if it happens, it'll be the courtesy of the supply shocks from the collapse of the global supply chain, not from what's happening with monetary dynamics.
It's because of too much money creation. That's what causes it. It's a loss of confidence in fiat money.
And Peter, Professor Wolff, you have the final word here.
Yeah, the story that Peter starts with is those low interest rates that enable corporations to borrow. But why start there? Why not ask the question, why the low interest rates? It was a decision of the Fed to which almost everyone agreed that we were on the edges of a disastrous collapse in the dot-com crisis in 2000, again in the Great Recession of 2008, again last year. Interest rates are lowered because you would have the collapse that Peter's talking about if you didn't do it. But then you solve. Well, let me just finish. When you solve the problem with the money, you create a new problem that is going to be perhaps even bigger than the old one. But you have to solve each problem as it comes along,
we have
because this system is so fragile.
Gentlemen, unfortunately, we are out of time in this show. This is a conversation we will have to continue sometime soon. Professor Richard Wolff, Peter Schiff, and Steve Keen, the economics professor of Patreon. Thank you so much to you both. And that's it for this time. We'll see you next time.